Okay. Okay. So we are going to start with risk and uncertainty, right? Risk and uncertainty. The first and most important thing here to understand is risk is a situation when we say that okay, fine, company did something like this before as well. Like for example, in the past year, we know that whenever petrol prices increases or fuel cost increases, what is going to be the impact on the industry performance, industry sales, right? So we have an idea about it. So we said, okay, fine, there are 60% chances that industry will respond positively, and there are 40% chances. Let me put it in a room with that. Okay. And there are 40% chances that industry will respond negatively, right? So we can attach a reasonable percentage with respect to how company will respond. And that obviously the accuracy of these percentages depend upon what we did previously, how similar project we did previously, yeah, or how many times a similar situation has occurred previously. That's basically how we can consider the risk value, right? Uncertainty is something that I personally think that a very relevant example can be this COVID. COVID is something that happened. We didn't have any, no one had any idea about how is going to industry will respond, what will happen in future. So that is a pure example of uncertainty that you have no clue because nothing similar happened before, right? So that's basically the area where we say that we are not in a position to assign the probability, right? So in case of risk, since we can assign a value of a probability, we generally solve this type of situation by using expected value. And in case of uncertainty, we have decision trees. Decision tree in the sense there are three things which we generally follow. The first one is maximax, the second one is maxi-min, and the third one is minimax regret. Right. These are three things which we generally follow in case of decision tree. Maximax is what? Maximax is the situation where we try to maximize the maximum available profits. Like we choose the maximum profits and then we choose the best one. Maxi-min in a situation where we try to maximize the minimum available profits, right? Minimum available profits. And minimax regret is a situation where we say, okay, fine, we need to identify the maximum regret and then we try to sort that out by reducing the maximum regret. So these are something which we decide when we have no idea, we have no clue that what happened. So what's going to happen? So we try to follow this. But if we can assign a probability with the scenario, then we generally go with expected value because there is a reasonable certainty that what are the chances that the first situation will occur and how much are the chances that second situation will occur. Okay, so if it comes with in MCQs, if the same question comes in MCQs, situation which I believe will be most likely because in CIMA and in ACCA, generally examiner will give you a table, a payoff table. Right. A payoff table. Payoff table, examiner will give you project A, project B, project C, uncertainty number one, uncertainty number two, uncertainty number three, and examiner will give you few values, and you are supposed to use those values. So this is the easiest condition. But keep one thing in your mind that always keep uh, controllable variable. Controllable variable is something about which we are going to take the decision, right? So always keep controllable variable on the x-axis, right? And always keep uncontrollable variable on the y-axis. And even if the examiner gives you some different graph, like transposed one. Try to redraw it like this because I think it will be easier for you to understand the situation, especially in Minimax regret, right? Um, or and if this question comes in section C, which is the constructive response question, and in that case, I think examiner will ask you to prepare a payoff table. Like examiner will not give you these values. Examiner will ask you to prepare a payoff table. For payoff table, as I said earlier, try to keep this thing in mind that you are always supposed to make a payoff table for with a combination of controllable, sorry, with uncontrollable figures, with uncontrollable variables, right? And then consider the other controllable and see the impact of with uncontrollable events. So that's basically how you are supposed to prepare the table. You can prepare table in another way also, but I believe that try to follow one procedure, one way of doing things. Don't try to do the experiments. Experiments will not be a good idea, at least in risk and uncertainty, right? So we are going to start with the first question. I tried to, initially I thought of doing MCQs, but in MCQs, it's just identify the risk and uncertainty. I mean, decision, apply the decision rule. So I didn't found it very uh, useful question, right? So what we are going to do, we are going to do this question quickly and we will do it on Excel, not on Word. Okay. Prepare a profit table that shows 6 possible profit figures per day. Now, important thing is you are required to do per day. So you are not supposed to multiply with the number of days and number of weeks, anything, right? And that is for 9 months. And then you are supposed to using the profit tables from part B. Sorry, it's quite early in the morning here in Pakistan. Using the profit table from Part B, discuss which type of motorbike the company should purchase considering the varying risk attitudes of the manager, and that is for 6 months, right? So let's see what we can do here. FX Deliveries is courier company considering purchase of new delivery motorbikes. They are evaluating 3 models, a standard, a heavy duty, and a cargo bike. The company is uncertain which model will be the most profitable one. The carrying capacity of each model is 50 parcels for the standard one, 70 parcels for the heavy duty, and 100 parcels for the cargo bike. So we are trying to explore 3 options. Capacity of each option is given. This is the lowest one, this is the mid range, and this is the highest range, right? Demand for parcel delivery is not constant, right? It can be either 60 parcels or 90 parcels per day, with a probability of higher demand being 75%. Higher demand means what? Higher demand is this one. So what will be the probability of 60 parcels? 25%. Okay. The revenue per parcel is $8 and the variable cost is $2 per parcel for all bikes. However, if a bike's capacity is not fully utilized, that is, its capacity is greater than demand, the variable cost per day is reduced by 15% to account for the lighter load because you are not having a full load on the bike. So they are saying that there are chances that on average variable cost will reduce by 15%. AD is concerned about the impact of turning away customers if demand exceeds the bike capacity. Demand exceeds the capacity means, let's say, if demand is 90% and 90 parcels, and you opt for 50 parcel bike, then obviously you have to turn around a parcel of I think 40 parcels. You cannot fulfill demand for 40 parcels. So in that case, uh, they will be having a problem. They estimate that a goodwill penalty of $75 would be applied against profit for each day. For each day this happens, regardless of how many customers are turned away. The daily depreciation charge for the bike is $15 for the standard, $20 for the DB, and $25 for the cargo bike. Historically, AD management has been very conservative, prioritizing risk avoidance. Now, this is an important statement because when you recommend, you probably see these areas that what the company's preference is. However, recent changes in the market have led them to consider more aggressive business strategy. Right. So first of all, what you're supposed to do, you are supposed to prepare a payoff table showing 6 possible profit figures per day. Now, uh, I'm just giving you 1 minute to think how you will prepare the payoff table. Just think how you will prepare the payoff table. Can you guys see this Excel sheet? I hope you can. How you will prepare this payoff table? Like what will be the combination? I'm just asking you to think for it. Okay. See, what is it?
We have two factors we can use. Like you said earlier, we have controllable factors and uncontrollable factors.
Mm-hmm. So, what are the controllable factors?
The controllable factors here would be the carrying capacity. I think so.
Okay.
I don't know.
See, you have to decide about what? You have to decide about which bike you will opt for, right? So this is basically a decision which you are trying to take. So whatever variable, I mean, what variable you are trying to decide is basically something which is under your control, right? So in case we will say that standard bike, there are three type of bike: standard, heavy duty, and cargo bike, right? Standard has a capacity of I think 50 parcels, right? Okay, let's write. I'm just writing it here because I just want to use it for my calculation. Capacity of bikes, like 50 bikes. Heavy duty is 70 bike parcel, sorry. And the last one, cargo, can carry 100 parcels, right? Okay. And then what is the problem? What is the uncertainty? Something which we cannot decide is actually about the demand. We don't know what is demand. So this is controllable variable and we will make its combination with demand. Demand can be 60 parcels, demand can be 90 parcels, right? And then control C, control V, and control V. Okay. Okay. Now think about the revenue. Think about the profits. Like how many columns you probably will need for the profits, right? The first and the most important thing is sales revenue, right? Revenue is something which you need for profit calculations, right? What else we need? We need variable costs, right? We need fixed costs, right? So variable cost is that is something we can use, and there's a goodwill penalty, right? There is, there is a goodwill penalty. Right? And then there is another cost which is depreciation, which is different for all. Right? Okay. And then we will calculate the profit, right? Okay. So sales revenue, what is the selling price right now? Okay. What is the selling price? Selling price
$8.
is $8, right? Selling price is $8. So selling price will be multiplied by what? Okay. If demand is 60 and you have a bike which can carry 50 parcels, how much demand you can satisfy? 50 or 60? Can you carry 60 parcels?
50.
50, right? So multiplied with this. Okay. Let me try to fill these columns. It will be easier for us. Okay. If we have demand for 90, but if we have demand for 90 and we have a capacity of 50, we can maximum fill 50. We can maximum mean 50 demand, right? If demand is 60 and we have a capacity of 70 parcels, how many parcels we can carry? We can carry only 60 parcels because we have the capacity, but we don't have demand, right? Similarly, if we have demand for 90, but if we have bike which can carry only 70 parcels, multiplied with 7, right? And then 8 multiplied by, we have demand for 60, capacity for 100, so I go for demand. So it depends upon the activity. If demand is high, we can carry maximum to maximum capacity. If capacity high, then we can meet the maximum demand, right? Okay, what about the variable cost? Variable cost, the question says that variable cost is generally $2, but variable cost is generally $2, but when capacity is not fully utilized, it will be around 15, right? So variable cost is $2. But in case of some less consumption, less usage of bike, variable cost will be 2 times 85%, right? So where we have less consumption, see, in the first part, we have demand for 60. Our bike can carry only 50, so we will carry 50 parcels. That means we will not have any idle capacity. So 50 times 2, right? Same. Okay. In this case, we have capacity for 70, demand is 60. Do you think that the consumption of bikes will be lesser? I mean, there will be some space left in the bike because
Yes.
demand is, yes. So then we'll multiply 1.7 with 60. Now we will multiply because there is no unused capacity, so we'll multiply 2 with 70. Okay. In this case, capacity is more. So we'll take this 1.7 times 60 and we will take 1.7 times 90. Right. Goodwill. Goodwill is only charged when we have we have to turn away any demand, right? So in this case, demand is higher compared with the capacity. So yes, we will charge goodwill of 75. In the next case, yes, 75. In this case, no, 0. What about this one? Capacity is 70, demand is 90. So we have to turn away around 20 customers. In this case, capacity is 100, demand is less, 0. Capacity is 100, demand is 90, no turnover of customers. Right. Depreciation will be 15 for standard. Yes, Linda.
Get the goodwill part. I thought it was the other way around. Can you please explain?
See, goodwill issue is that when you have more demand, like the question says that, let me try to highlight it. The estimates, they estimate that the goodwill penalty of 75 would be applied against profit for each day if this happens. What will happen? AD is concerned about the impact of turning away of customer if demand exceeds the buy. So whenever this happens, that demand exceeds the buy, demand exceeds a buy capacity. Like demand is 90 and the capacity is 70, let's suppose. So you cannot offer services to 20 people, right? What will happen? Those 20 people will get. You are going to a certain place, and the guy is saying we cannot take your parcel because we don't have enough capacity. So obviously you will get frustrated and you will go to some other customers. So they are saying that we have to charge a penalty sort of thing, a notional charge, that because we were unable to satisfy the customers. Customers are going to another company for taking the services. So they are just charging it a sort of penalty against the company so that they can identify kind of opportunity cost. You can say opportunity cost could have been a better word in this case, that you could have got an opportunity of something, but you are unable to get it because you didn't opt for higher capacity buy, right? So actually it's like this. Is it okay?
Yes, thank you.
Welcome. If you have any questions, just unmute the mic because I have to go switch the screens for that. Okay, 20 for heavy duty and 25 for the cargo bike, right? So what will be the profit then? Profit is simply the difference between revenue and cost, right? Um, so the revenue is 400. Right? Revenue is 400 and the cost is this one minus this, right? And if we just write control D, so we can, okay. So these are what? These are the 6 profits. Now, how you will apply? Now, what they are saying, prepare profit for the 6. This is something which we just did. Now, using a profit from part B, discuss which type of motorbike AD should purchase, considering the varying risk attitudes of manager. Now, this is a quite tricky part because in this case, examiner didn't tell you what to do, like maximax, maximin, minimax, regret, or maybe expected values, right? So what you can do is you can try to see what are the risk attitude what are the risk attitude of managers, right? So in this question, what they said is historically AD management. Let me try to use a different color. AD management has been conservative, prioritizing risk avoidance. So this is the first idea which we are getting about management thinking, that management is not ready to take risk. In this case, which method we can follow? In this case, we can follow maximum. So the first which we can, because this is for 6 marks, right? For 6 marks, you have to at least do 2 to 3, right? Then they are saying, however, recent changes in the market would have led them to consider more aggressive business strategy. So if you're trying to have more aggressive business strategies, you are trying to go for the maximum options. In that case, you can choose Maxi Max. There's one more thing which you can do is if management wants to go for risk neutral approach and they want to trust on expected values, they can go for expected values, right? Because this will give them the experience of the probability that, let's suppose if we trust the probability, what could have been the answer, right? So 2 marks per option with the reason that why you chose so, right? So if you want to choose the maximax option, we have to identify the maximum profits, right? Maximum profit from what types of bike do we have? Standard, uh, and what was that? HD and CV. HD and CV. So what is the maximum profit from this one? 210, right? HD maximum profit is 358 and CB maximum profit is 542. And we have to choose maximum from the maximum. So for maximax you should go for courier bike because it has the maximum profit out of all the maximum available profit. Right? For maximin, we need to identify the minimum profits. Right? These are the maximum profits. Okay. So what are the minimum profits? Minimum profits for minimum profit for this one is 210, right? This one 325. And for this one, minimum profit is 353. So the best option is CV, right? So for maxi min, the company should follow maximum profits out of minimum available profits. So that will be CV also, right? But if company wants to, this is kind of risk averse situation. This is risk seeker situation. And this is risk neutral condition, right? So what we are supposed to do, we are supposed to copy and paste all these values here, right? And then what we can do is we can copy these. So for standard, what are the probabilities? Probability of 60 parcel is 25%. So 0.25 and 0.75, right? Okay. So we just need to multiply these two figures and here we need to sum. Okay. This plus this plus. So what are the expected values? The highest expected value is again for CV, right? This is just a coincidence and for all cases CV is the best option, right? So if you want to, you have to write one statement that why you think that why you chose maximin, why you choose maximax, and why you choose uh, maximax, maximin, and expected value, right? So we choose. So if company wants to, if the managers are still in with an opinion that they don't want to take risk, they want to avoid risk because of probably because of the financial condition. It's not given here, so don't write it. I mean, don't write about the financial condition. So if managers wants to continue with the risk avoidance attitude, they can follow maximum, right? Then in the second paragraph, we will say that, okay, fine, if management wants to have more aggressive policies as discussed in the question for future projects, in that case, company should again go for CV, right? Right now, all is CV, but generally it's different, right? And if company wants to, what is the name of company? Company's name is AD. So if AD really wants to go for risk neutral approach, considering the probabilities of the events, then it can go for the third option. So we generally write 3 paragraphs, 3 small lines, because 2 marks are per option, right? So 1 mark for the calculation and 1 mark for connecting it with the scenario. That why you think that this is a better option, right? Let's try to do one more thing here. Let's try to identify that mini-max regret, because that is something which we didn't do, right? How can we do it? Okay. So for mini-max regret, first of all, we have two variables now. We have two columns, x-axis and y-axis. So on x-axis, we generally keep the controllable variables, right? Okay. So at this part, we will keep the controllable variable. And on this hand, we will keep the uncontrollable variable. Uncontrollable variable are the bikes, right? And in this case, we will consider the demand. Right? So demand can be 60 and demand can be 90. Bikes can be standard, HT, and CB. So first we will write all those profits. For HT is 358 and 325. For C, it's better to link, because in case you forgot something and you change it later, everything else will change accordingly. Okay. So now we have to identify, this is the payoff table. Now we have to make the regret table. Regret table will be quite similar, right? I think. Okay. Now for regret table, we need to identify the regret. So if 60, if we have uncertainty of 60, which project is the best for us? For us, the best project is HD, right? So if we choose HD, we will have 0 regrets, right? If we choose smaller or whatever the standard bike is, we will have a regret of 358 minus 210, right? If we choose CB, we will have a regret of 358 on a daily basis minus 353. If the demand exceeds to 90, then the best profit is for this one, for the CB. So if we choose CB, we will have 0 regrets, right? If we choose HD, we will have a regret of this one. And if we choose smaller buy, we will have a regret of this minus this. So what are the maximum regrets? Maximum regret is 332, maximum regret is 217, and maximum regret is 5, right? Since we want to minimize the maximum regret, therefore the AD should choose CB. CB was, I think, cargo bike, right? Because this will have the minimum regret, this one. This part has the minimum regret. Right? So it's just a coincidence that all decisions are giving you the same result. And this is probably one of the examples that you should not be concerned in examination if you are getting same option in all cases, because generally students start doubting themselves that, oh my God, probably I did something wrong, right? Now, I just want to show an MCQ and okay. Um, can you try minimax regret with this one? First try maximax and then try minimax regret. I'm giving you 2 minutes to do this. If you have um, um, notebook and pen with yourself. Okay. I'm not sure if you have identified the problem in this question. This is a kind of MCQ. I mean, similar thing you can find in MCQ or maybe MCQ. That examiner give you a box of table and examiner will ask you to identify the solutions, right? How you will do the maximax? For maximax, you need to identify what are the decisions you are trying to take, right? So the decisions which you are trying to take is about the selling prices, right? So if selling price is 80, if selling price is 80, what is the maximum profit you will have at selling price of at $80 selling price? Maximum profit is 90,000. At $90, the maximum profit which company can have is 100,000. At $100, the maximum profit which company can have is 90,000. And at 110, the maximum profit which company can have is 80,000. Right. So these are the maximum options at different selling prices, maximum profits which company can generate at different selling prices, right? So if you really want to choose Maximax, Maximax will be this one, right? Maximax is not a problem. In this case, Minimax regret is a problem. Can you do Minimax regret by using a similar the same table? Yes, we can do. But you have to keep one thing in mind that the probabilities, the uncertainty is here. And what we discussed, where should have been the uncertainty? What we try to do is we try to keep uncertainty here on the y-axis. In this question, uncertainty is on the x-axis, right? So you have two options. The first option is you have to transpose your way of doing, right? Now you have to think either change the first option for you is either to change this whole table. Obviously, it will take time, but you will be in a comfortable position in that. Otherwise, if you understood the concept, you have to keep in mind that you have to, if you are trying to go for regret table, let me try to make a regret table here. Or let's um, copy and just paste this figure in on Excel, right? Okay. Oops, sorry. So if you want to do a similar thing in this case, what you will do, you will try to make a regret table, but regret table will be not on the downside. Regret will be on the y-axis, right? So I think it's better to do it like this. Okay. We have to calculate few things. Okay. So if you make the regret table, I'm just trying to tell you how you are going to do this. You may try it at your own if you are getting out of time. Strong, medium, and this 80, 90, 100, and 110. Okay. So if strongest demand occur, what is the best option? If strongest demand occurred, then you will not have any regret if you chose $90. So at 90, you will not have any regret. If you are using the similar format what is given in the question. Otherwise, transpose it if you are uncomfortable with it. If the demand is strong and we chose $80, we will have a regret of 80 minus 70 is 10,000. Right? If we choose 70,000, we will have a regret of 10,000. And if we chose 75, we will have a regret of 5,000. Right? We are not doing it like this, we are doing it like this because table is on a different mode. Right? For medium, the maximum benefit is here. Right? In this case, maximum benefit was here. So if we choose medium, we will have a regret of 30,000. If we choose this one, we will have a regret of 20,000. And okay. For weak option, if weak, I don't know what is the environment, but maybe whatever it is, reaction, competitor reaction is weak. In that case, the best option for you is to have a selling price of 90 because that is giving you the maximum benefit. Sorry. If we choose 80, we will have a regret of 10,000. If we choose this 10,000 and at this one, it's going to be 20,000. Right? Now, generally we have regret, we try to identify the maximum regret on the x-axis, right? Now we are not going to do it. It will be on the y-axis, right? So at $80, at a selling price of $80, what is the maximum regret? What is the maximum regret? Maximum regret is 30,000. At $90, the maximum regret is 20,000. At $100, maximum regret is 10,000. At $110, maximum regret is 20,000. So you have to identify what is the maximum regret. Maximum regret in this case, what is the minimum regret? So out of all these options, the minimum regret will be the 10,000, right? So 10,000 means you have to do the selling price of $100. So the first option is to do it like this. The second option is, if you think that this is going to be too much for you and you are unable to do this, what you can do is try to spend just 1 minute or two to transpose this table into strong, medium, and weak, 80, 90, 100, and 110. Now we can proceed with a similar way what we did before, right? But first, make a transpose table. I hope you guys know what is transposition. So, like this will come this one, like 70,000, 50,000, and 90,000, and so on. So, try to understand whenever there is an MCQ, first see what values are on the x-axis and what values are on the y-axis. Because if the question is like this, like you are preparing all these tables, you know how you are going to make this box. But if the box is given, try to understand the situation. One more thing. When you see the MCQ, try to understand the heading. Generally, what if I give you a regret table in MCQ? Regret table means what? Regret table means in the MCQ, I will give you let's suppose selling price of $10, selling price of $12, selling price of $14, and then let's suppose a poor weather, average weather, a good weather, right? And I said that okay, fine. If so regret table means that examiner has already identified all the regrets and has given you this one, this table. This is the regret table. So if examiner give you this regret table, you are just supposed to perform the final step. Final step means that at $10 maximum regret is 15,000. At $12 maximum regret is 12,000. Here the maximum regret is 8,000. So since we have to minimize the maximum regret, we will choose 14. So try to be careful with regret. This is something which I always believe is difficult for students. Right? Any problem? Okay. Now, this is one more thing which I wanted to discuss through this MCQ. This is a good MCQ. I got this from BBT. Um, Further process. Do you remember further processing? Further processing means that we did a process, right? We got some solution, we got some product. Now we are in a now we are trying to identify. We are in a stage of deciding whether to sell this product as it is, or whether we should further process it and sell a refined product. Let's suppose that you did a process and you got some fruits, right? Maybe you got some apples, some pineapples, or something. Now you are trying to decide whether to sell raw form fruits in a raw form, or whether you should process it and sell fruit juices, right? Or you got oil in a unpurified form, and then you are trying to decide whether to purify the oil and then sell, or sell unpurified version. So that's basically what we are trying to decide. Now in this case, generally what examiner do is, it can come in MCQ, it can come in MTQ, it can come in the final section C question. All it has the tendency. So there will be 2 to 3 things. The first thing is that examiner will give you details about the common process. We will discuss this. Common process. Like we spend $50,000 for material, we spend $20,000 for labor. we spend around 90,000 for overheads, right? And then we got two products, product one and product two, right? And then we are in a position, we are in a state of deciding whether to convert P1 to PP1 or P2 to product final PP2. Let's give the same PP2. We are in a state of deciding what to do, right? So generally, what examiner will give you, the cost of processing, like 50, 20, and 90. Let's suppose it's 160,000. So examiner will give you this $160,000 cost, and examiner will tell you the way they have distributed this 160,000 to P1 and P2. Trust me, this 160,000 is always an irrelevant cost. Always is a big statement. Is always an irrelevant cost. Why? Because we are standing here, right? Not here exactly. Yeah, we are standing here. We already have P1 and P2. This is called split of point. We already have P1 and P2. So this expenditure has already been done. It's a kind of sunk cost for the company. You cannot recover this cost. We are trying to identify whether this should be converted into this and this should be converted into this. For in this case, generally we have two things. The first thing is examiner will tell you that look, P1 has a selling price of $20, P2 has a selling price of, let's suppose, $30, right? This is the selling price. And we got around 5,000 units of P1, we got 20,000 units of P2. But if we further process 5,000 P1 to PP2, there will be a 20% loss in the process. And PP1 can be sold at, let's suppose, $30 per unit, right? And this process will require around this further processing cost will be around $4 per unit. Now tell me whether P1 should be converted to PP1 or not. I'm not talking about PP2 because what you will do to PP1, that would be the same procedure for PP2. So whether you will convert it or not. So the first thing which you are going to do is to calculate the incremental revenue. In incremental revenue, try to make sure that you are trying to calculate what revenue from P1 minus revenue from PP1 minus P1, right? So revenue from P1 will be what? Revenue from P1 will be 1,000 multiplied by 20. And what would be the revenue from PP1? PP1 can sell at $30. But this $30 you can get $30 after incurring a loss of 20%. Like what would be the quantity? What would be the quantity of PP1? 5,000 times 80% times 30. You need to take the difference of these two figures in order to get the incremental revenue. And then we calculate the incremental cost. Incremental cost will be 4 only. This cannot be classified as incremental cost because this is a sum. So we multiply 4 with what? We will multiply 4 with 5,000 because further processing cost is generally applied to the whole output. Like you start manufacturing on 5,000 units, you incurred some expenses, and then ultimately you got 80% output. So 4 will be multiplied by 5,000, 4 5 is 20. And whatever the figure is, let's suppose we got an incremental revenue of 50,000. So 30,000 will be the incremental profit. You should continue with the further processing. But if incremental revenue is 5,000, so this will be around 15,000, and this will be a loss, so you should not continue with further processing. So that's generally what we do. There are chances that examiner will also give you some fixed costs. Like let's suppose examiner says that if we process P1 to P1, we have to hire a machinery, and that's fixed tax cost is around 5,000 per month, and we are talking about 1 month decision. So obviously you have to deduct 5,000. Right? Now I'm giving you some time to read this question. It seems that this is a decision tree question, but this is not. Read this question and try to identify what to do. Or let me read this because I'm not sure how much time we have. We have enough time. A manufacturing company makes two joint products, CP1 and CP2, in a common process. So it's important to understand that CP1 and CP2 are made in a common process, right? These products can be sold at a split of point in an external market or processed further in separate processes to produce product FP1 and FP2, probably final product 1 and final product 2. Details of these processes are shown in the diagram. Now, this is the diagram. First, try to understand the diagram at your own, that what you can understand from what is given in the question. Okay. We made an input of 10,000 kgs, 5% common process loss. We got 5,000 kilograms of CP1. We got 4,000 kilograms of CP2. Then we are trying to identify for the processing. If for the process, we will lose 10% of input and we will get FP1. If we process CP2, we will use 5% of input and we will get FP2. Right? In this whole situation, do you think this 5% losses are a relevant figure? We should include this 5% in our processing, in our calculation. Do you think like this? No, right?
No.
Because, sorry, you're saying something?
No, is it because you said it's any cost at split off point, it's irrelevant?
Yes, because the split of point is irrelevant. So, because see, if you take 10,000 times 95%, because it's 5% loss, you will get around 9,500, right? 9,500, if you 9,500 minus 5,500 is giving you 4,000. So that is already a splitted version. You don't need to do anything here. Examiner gave you something because students think that it's given. So let's consider this in calculation. Somehow they consider it in the calculation. Anyway, what's next? Then they are saying that CP1 has a market price of $6 per kg. And CP2 has a market price of $5 per kg. Right? This is the selling price is around $5. Relevant further processing costs are 2 per input kg in process to make FP1. So this is a very good question. The examiner is giving you that, look, this is the input kg cost. Generally, it's not mentioned specifically. You have to assume that input cost is for the input quantity, right? Because for the process, the variable cost is around $2 for CP1 and 3 per kg for FP2. Right? And both FP1 and FP2 are sold for 9. So selling price of FP1 is 9. Right? We will do FP1 here. I think if you can do FP1, you can also do FP2, right? So how we can do FP1? Can we do it on Excel? Mm, I hope we can. Okay. Okay. So let's try to go for FP1, right? Um, what is the current revenue? Or we can say revenue from CP1. CP1 will generate a revenue of 5,000 multiplied by 6. What is the revenue from FP1? The revenue of FP1 will be 5,500 times what percentage? 90% times, because selling price is $9, right? So this minus this. This is the incremental revenue. And what is the incremental cost in this case? Incremental cost will be 5,500, right? 5,500 times 2, right? So 11,000, 14,550 minus 11,000. I think we did something wrong here. CP has a market price of 6. Oops, this is 5,500. CP has a market revenue of 5,500. This has a market, this is 55 times 90%. So is this is the incremental revenue? This is the incremental cost, and this is the incremental profit. So if this figure is positive, it's incremental profit, right? This is for FP1. Obviously, you will not get any answer from here because this is the combined cost, right? For 10,000 kilograms, if we further input 10,000, if we process this 10,000 kgs, what will be the benefit? This is something like that, right? So this is the first part which we just did, right? Should we start with CVP or should we take a 5-minute break?
A break, please.
It's too early in the morning. Okay, we can have a break. And it's 9:06 at my end. We will resume at 9 after 10 minutes, according to whatever time is at your region. Okay, so we are going to start with CVP analysis, right? CVP analysis, of course, we did it in our session, right? The regular session. So I'm not going to write everything again. I'm just going to do a quick recap of what we discussed, and then we will quickly start with an MCQ, right? Which has been asked in examination. So we have two cases. The first case is a single product, and the second case is for multiple products. I hope I am audible, right? Okay, the first case is single product. The second case is for multiple products. So the idea for multiple product is quite simple. You have to consider for the break-even point. Like there are three things which we generally calculate in case we are dealing with CVP analysis. The first thing which we do is to calculate break-even point. The second one is margin of safety. And the third one is uh, sales volume to get a specific targeted profit, right? These are three things which we generally try to identify whenever we are doing a break-even thing, right? CVP thing. They start with multiple products. I'm not doing single product today. Um, the formula is simply total fixed cost divided by contribution per pack. Let me try to give you a basic idea of how to calculate contribution per pack because this is the most important thing. Otherwise, it's easier. So, contribution per pack means what? Contribution per pack means that you have to first of all, the first step you need to is to simplify the sales volumes, right? For example, there are two product A and product B. 5,000 units you want to sell for product A, and let's suppose 18,000 units you want to sell for product B. So there is a ratio of between A and B, that what will be the sales volume of A and what will be the sales volume of B. And how you can finalize the ratio? Ratio can be finalized by simplifying it. So if you simplify this will be 5:8, right? And examiner will give you a contribution. So let's suppose product A has a contribution of $10. Let's suppose product B has a contribution of 80%. B has a contribution of $5. Let's make it this one 10 and this one 5. Easier for us to calculate. So how you will calculate contribution per pack? Contribution per pack means we will say, okay, fine, if there is a pack, there will be 5 units for A, and there will be 18 units for B, right? So contribution per pack will be 5 times 5 and 18 times 10. So this will give you contribution per pack from one packet. So if let's suppose this is 500, let's suppose, and fixed cost is around 1 lakh. So we divide 1 lakh with 500, and you will get some figure, like I suppose 200. So this means that you have to sell 200 packs, right? You have to sell 200 packets. And how many units of A and B you should sell? In one packet, there are 5 units of A, so multiply by 5. In one packet, there are 18 units of B. So multiply it with number of packs, and you will get the final product, the break-even, right? That's break-even in units. And how you will calculate the margin of safety? Margin of safety is how much extra you are selling over and above your break-even point. As we discussed in our calculations, that margin of safety is something which is going to give you profit. The more margin of safety is, the more profit will be for the company. So if it is simply compare budgeted sales with break-even sales, right? So it will be same like for A and B. Let's suppose that break-even point is 1,000, and break-even point is, let's suppose, 9,000. So if the budgeted sales of company is around 4,000 units of 5,000 units of the first product, and 18,000 units of the second product, it will be 5,000 and 9,000 margin of safety. I'm just giving you as business success, right? And then sales volume to our targeted profit, we just simply add profit in the fixed cost in order to get the final result. So if you want to generate a specific profit, you have to use same break-even formula, with the only difference is that in numerator you have to add profit. Rest is same. Right? If you want to calculate break-even in revenue. Now, this is tricky. If you want to calculate break-even in revenue, and in denominator, you need to have contribution to sales ratio per pack. Per pack means we already have contribution per pack. We simply need to divide it with the sales revenue of one packet. You will get the sales ratio. And then we can distribute the revenue between A and B, right? Same goes with the margin of safety. Margin of safety, we take the difference between budgeted sales and break-even sales, and in sales volume to our targeted profit, we will simply add profit in the numerator, right? So we are trying to do all these things by using an MCQ. Let's try to do all these things by using an MCQ, right? Okay. So let's try to have questions here. Okay. So this is a question which has been asked in performance management paper, right? It's a past paper question. Let's see what is given here. Okay. Here Event is a company which specializes in organizing sports events in major cities across the land. It has approached the local council of Adams, a city in the north of the land, to request permission to host a running festival. To request permission to host a running festival which will include both a full marathon and half marathon race. Based on prices, it charges for entry to similar events in other locations. The company has decided to on an entry fee of $55 for the full marathon and $30 for the half marathon. What is this? Is this a cost or is this a revenue? This is the selling price, huh? Prices or the income per person, right? It expects that maximum entry will be 20,000 for full marathon and 14,000 for the half marathon. This is basically the sales volume. In general language, we call this a sales volume. Right? Here, Event has done a full assessment of likely cost involved. Each runner will receive a race pack on completion of the race, which will include medal, t-shirt, water, and chocolates. Water stations will need to be available at every 5 kilometers kilometer point along with the race route, stocked with sufficient supplies of water, sports drink, and gels. So these are the facilities or things which we are able to give to runners. These costs are considered to be variable as they depend on the number of race entries. Right? So these all are variable costs, right? Okay. Then it says that here event will also incur following fixed costs. It will need to pay a fixed fee to the city council for COVID, so that is the fixed cost, road closures, and support from the local police and medical service. And all these are fixed. A full risk assessment needs to be undertaken for insurance purposes. A marketing campaign is planned by advertisement on running website, in fitness magazine, and in other events. Here event is organizing in team and the company which here event is usually employed to raise photography has been approved. So these all are fixed costs. The details of the costs are given. Race pack 15.8 is a variable cost, 10.8 for half marathon, then full marathon and half marathon. The overall costs are given. Right. So 15.8 plus 2.4 and 10.8 plus 1.2, these are the variable costs, right? Then it's a fixed cost. There are some fixed costs, council fee, risk assessment, marketing, photography, all of these fixed costs. Now the post requirement. If their event decides to host only full marathon race, that means we are talking about just one product. What is the margin of safety? So if we are just doing for one product, we are not supposed to calculate the mix thing because mix is generally done when we have more than one product. Right? So let's just start with some basic calculation on Excel, right? So this is basically the first MCQ we are doing, right? Um, and for that, we need to margin of safety means what? Margin of safety is the difference between budgeted sales minus break-even sales. But the problem is that margin of safety, all options are given in percentage. So actually, examiner is asking about margin of safety in percentage. And for that, we just simply divide it with budgeted sales. This is the margin of safety in percentage. So we need to get break-even, right? How you will get the break-even for only marathon race? Okay, let's identify the selling price. Right. What are the charges? Charges are 55 for full marathon and 30 for half marathon. Right. Charges are full marathon and half marathon. Charges are 55 for full marathon and 30 for half marathon. We are not supposed to do half marathon things right now because it's not the requirement, but we are doing it, so let's calculate it. And obviously, when you are doing MCQ, workings doesn't matter, right? So charges are 55 and 30. And what are the variable costs? Variable costs are 15.8 plus 2.4, right? Here it's 10.8 plus 1.2, right? So what would be the contribution? Contribution is 15 minus 8.2, and we'll do C here. Okay. And what are the fixed costs? Fixed cost is a sum of all these. I mean, obviously we'll include all these. So 300,000 plus 80,000 plus 5,000. Okay. So what will be the break even? Break even will be fixed costs divided by contribution for full marathon only, because we are now believing that we are will only do the full marathon. So this much units you need to sell. And what will be the margin of safety? Margin of safety will be budgeted sales minus break-even sales. Budgeted sales volume of full marathon was 20,000. This one, right? So 20,000 minus this figure. This is margin of safety, but this is margin of safety in units. Like in this case, we can say this is runners, right? But we don't need in units. We need in percentages, right? Figures are options are in percentages, right? So how do we calculate margin of safety in percentage? Is margin of safety divided by budgeted sales. Budgeted sales are 20,000. Right? 47.67. 47.69%. 47.69%, that is option B. Right. Okay. What is the next part? Next requirement is interesting. Now they are saying that assuming that race entries, I hope it's visible. Okay. Assuming that the race entries are sold in constant sales mix based on expected race entry numbers, what is the sales revenue of event need to achieve in order to break even? Right. You are supposed to calculate break even in terms of revenue because answers are in revenue. Right. So how you will calculate break even in revenue? Let's try to add one column here. Okay. So how many units are for FM and half marathon. It says that 20,000 units are for full marathon and 20,000 units are for full marathon and 14,000 units for half marathon. So original estimate is 20,000 and 14,000. Okay, just a second. Okay. Now, if you simplify this, I'm not sure how to explain that simplification thing, but it will come down to, I think, 20 and 14. And 20 and 14 will come down to 10 and 7. There's one more thing. I will explain it to you later with respect to revenue, that whether this ratio is required or not. We will do it later, but right now we are just going with the flow. So 10 units and 7 units are required for the package. So let's go for the second part, which is margin of safety in break even in revenue. Right. So what we need contribution per pack. Right. Contribution per pack means for full marathon. Just let me know in case you are unable to understand anything. For full marathon, we have 10 units and contribution of 1 unit is 36. For half marathon, the contribution is 18 and 7 units are involved in one. So this will be 368 plus 126. So contribution per pack is this one. And since we need contribution to sales ratio, if you try to remember break-even in revenue, that is fixed cost divided by CS ratio per pack. So we got the contribution, we need to get the revenue now. So let's do the same calculation with revenue. Let's do it here. We'll get space. So for full marathon, this will be 55 multiplied by 10. And this will be 7 multiplied by 18. Right. So if you add these two figures, this is what? This is revenue per pack. Right. This is revenue per pack and this is contribution per pack. Okay. Now, contribution to sales ratio will be what? Contribution to sales ratio will be contribution divided by sales, revenue per pack. Right? And then you have to calculate break even in revenue, which will be equals to fixed cost divided by CS ratio. I think we did something wrong here. 10 into 36.8, 7 into 18, right? I think there's something wrong. 55 into 10 and oh, it should be 30. It should be this way. So this is 592,307, right? 592,307. 592, you have to choose the nearest $1,000. That will be 592. So this is the overall break even. Now, one more thing which I just want to tell you guys, if you are not, now try to listen it very carefully. If you are not comfortable with this ratio thing, then you can consider total contribution and total sales. Ratio will remain same. But don't do this with break even in units. In break even in units, you have to do the ratio thing, right? So in revenue, you have an option. Now, so we got the answer, but we will do one more calculation here later. One more calculation we will do here later. Right? Let me try to bold and let me try to make some change. Now, the third requirement is now the company wants something more from you. Now the company wants to achieve a minimum total profit of 500,000 from running festival. Now company wants to have 500,000 from the running festival. What are the number of entries? So they are talking about the number of entries. Break even in your in unit. Here events will have to sell of each race. That is marathon and full marathon and half marathon. In order to achieve this level of profit, which level of profit is one? Assuming that a constant sales mix based on expected days entry number of supplies. So now you have to calculate the third requirement is to calculate sales volume to earn targeted profit, right? So what is the formula for that? Formula is to consider fixed cost plus targeted profit divided by, since this requirement is for unit, you have to divide it with contribution per unit. Perfect. Right. So let's calculate fixed cost. Fixed cost, we already know fixed cost is 385,000, right? How much profit we need to generate? We should have a 500,000 profit, right? Do we have contribution per pack? Fortunately, yes. We have already calculated it 494 here, right? So sales volume to earn 500,000 profit will be what? Fixed cost plus targeted profit divided by CS ratio. Now this is um this 1791 is not units. These are the number of packets. So for full marathon and half marathon, in one packet, how many units we have? 10 units of full marathon and 7 units of half marathon. Like 10 and 7. Right? So that means if one packet will open, multiply by this one. And 7 multiply by this one. So 17914, 17915, and 12541, 12540. So we have to, this is option A. Full marathon 17915 and half marathon 15540. This is an interesting requirement. I really like this requirement. The second last one, this one. Try to read it very carefully. Here, event is also considering including a 10-kilometer race during running festivals. It expects that the race will have an entry fee of $20 per competitor and variable cost of $5 per competitor. So the selling price is given, the variable cost is given. Fixed cost associated with this race will be around 48,000. If the selling price per competitor, variable cost per competitor, and total fixed cost for this 10-kilometer race all increases by 10%. All increases by 10%. Which of the following statement will be true? Try to think for a minute. how we will do this? What will be the strategy? How we will do this? Not asking you to do this. I'm just asking you to think how to do this.
I think we I think we need to just know the formulas of calculating the break even in volume and break even in revenue first.
Okay, let's try this. Oh wait. Okay. Sorry. So fixed cost is 48,000, right? Selling price or the entry fees is 20, and the variable cost is around 8, right? So the contribution from this race, what we are expecting is 8, right? We will do just for this race. We are not supposed to continue with the full marathon, half marathon, and this, right? So this is the original version. And what would be the break even in units? Because the question is asking about break even in volume and break even in revenue. Both options are given in the requirements. So fixed cost divided by contribution, break even is around 4,000, right? Now the question is saying that let's suppose that everything increases by 10%, which means what? Which means that this will increase by 10%, this will increase by 10%, and this will also increase by 10%. So contribution will be around 13 point. What will happen to break even? 52,800 divided by break even in contribution per unit. So the break even will be around 4,000. Is there any change in break even in units? Okay. Now here comes the problem. Since the students think that break even in units have not changed, this is something which I've already done in experience in my session, in my class. Since students think that break even in units is not changing, has not changed, they simply mark option D. This one. They consider that okay, my break even in units is same, break even in revenue will also remain same. No, you have to check this, and I will tell you the reason why. Break even in units, break even in revenue. Fixed costs divided by CS ratio, contribution over sales, right? And we will do same here. What is the difference? Difference is 8,000. So break even is increasing. There is a change in break even. Question is specific with respect to percentages. So let's try to calculate percentage. Simple. Change divided by the base figure. Base figure is 80,000. It's 10%. Right? It's 10%. So your break even in volume will not change, but your break even in revenue will change. And that makes sense. Why? Because you remember one thing, there is a link between break even in revenue and break even in volume. Break even in revenue is equal to break even in volume multiplied by the selling price, right? So if originally 4,000 units were in break even, 4,000 multiplied by 20 will give you 80,000. In this case, 4,000 multiplied by 22 will not give you the same figure. So technically, if volume is same and selling prices are increasing, revenue will automatically increase, right? So that's basically how you are supposed to do this. So majority actually marked option D. That is something which is a problem. Okay, now this is something which we forgot to discuss. Yeah. there are two things. The first thing is assumption of CVP, and the second one is conditions at break even. This is something which I forgot to discuss. There are four assumptions of CVP analysis. The first assumption is that selling price will remain same at all sale volume. Whatever unit you will say, the selling price will remain same. Like it's not the case that if you want to have more volume of sales, you have to reduce the selling price, which is generally the case in the market. So they're saying you have to ignore this. CVP doesn't have the capacity to adjust that. Variable cost per unit will remain same at all production volumes, like kind of thing which we just seen that if the change is in the activity, variable cost may change. So they are saying you have to assume no. Total fixed cost will remain same. So there is no step up in fixed cost also, and sales and production will generally remain the same because we are trying to make sure that we are producing the same units which we are going to sell. Right. Now, on the basis of this information, can you answer this question? Just a second. Can you answer this question? Okay. Production level and sales level are assumed to same if there is no inventory so that there is no inventory movement. This is something we just discussed. This is true, right? The contribution to sales ratio can be used to indicate the relative profitability of different products. Is this statement correct? Let's suppose that there are two products, product A and product B. Contribution to sales ratio of product A is 60% and contribution of B is 20%. Can you say that product A is more profitable compared with product B? Yes, because that is generating more.
Yes.
Yeah, and this is something which we also consider while making the graph of mixed products, of multiple products. Sorry. This is also correct. CVP analysis assumes that fixed cost will change its output either fall or increase significantly. No, this is not the, I mean, this is not, yeah, this is
False.
selling prices are recognized at different activities, especially if higher volumes are needed. So that, yeah, so that is
False.
one. So these assumptions, again, yeah, exactly. These assumptions are important. And one more thing which I said, I will discuss it. Okay. See, we have calculated break-even in revenue. Overall break-even revenue, we got it. But if someone says that what will be the break-even in revenue for full marathon and half marathon separately. So if you want to split this 592,000 between full marathon and half marathon, how you can do that? We start with a break-even and we distribute it on the basis of sales revenue per pack. So we divide it with, what is the sales revenue? This one. We divide it with 760 and multiply this with 550. Right? We divide this whole thing with 760 and multiply this with 210. Right? And if you really want to check this, all these options, we calculated break even in units. No. No, break even in units we didn't tell you. So if we calculate break even in units and we can multiply it, we will get the same figures, right? So that's basically how break even in revenue of individual products can also be calculated, right? Okay, so we are done with CVP analysis. Now we are moving towards rolling budgets basically, right? Yeah. So there are some different types of budgets which we have discussed in our budgeting chapter, right? I don't think we need to take a break here. So let's try to quickly go through all those budgets. We will do two questions, one for rolling budgets and one for activity-based budgeting. Right. So let's quickly go through all these things. So incremental budgets, we know. Conditions I'm telling you, and I'm just telling you how examiner can ask such questions. See, let's suppose you in incremental budgeting means that you we are recording this now. Okay. Incremental budgeting means that we are considering whatever happened in the last year. We are adding certain percentage, deducting some provisions, and we are coming up with a new year's budget. We are not making a serious attempt to go with the assumptions or anything else. We are just trying to continue with what we did before. Now, in what circumstances do you think that this is a good idea? Because if we are studying this, definitely it's applicable somewhere. So if you see in a scenario, if you are seeing a scenario that examiner is saying that, look, a company is in a business which is reasonably constant in its activities, like sales, there's a constant increase in sales volume, like every year sales volume increase by a certain percentage, let's suppose 2% or maybe 3%. Economy is stable and there is no uncertainty in the environment. In that case, you should follow incremental budget because situation is not dynamic, situation is not changing. So incremental budget is a good idea in that case because it's a quicker method. It's already considering the last year attempts and it's avoid inventing the wheel like you are trying to start with the new thing. But what are the disadvantages? I'm just reading. I'm not reading it. I'm just telling you. I will share all these notes with you guys. Don't worry about that. So what are the disadvantages? Disadvantages is that you will carry whatever if there's something went wrong in the last year, in the past year's budget, you will continue with the same thing. Okay. Rolling budgets are on a different side, like it's a 180-degree change. Not 180-degree, I mean, we are trying to change the assumptions. We are saying that, hey, look, right now I can give you an example of what Trump is doing with the reciprocal tariffs, right? Recently, it has implemented some tariffs on India and I think on Brazil. So the situation is uncertain right now. So we really don't know what will happen in next few months and how the economy will shape, how the exports will end up, what will be the situation of imports, exports, and whatever things are. Basically exports. So situation is uncertain. And let's assume that today is right now it's the end of December and we are in the process of preparing the budgets. Do you think it's a good idea to make budget for the whole 12 months? Of course not. So if there is an uncertainty in the environment, you cannot prepare budget for the whole year. Rather, what you can do is you can go for a rolling based approach. Rolling based approach in the sense that let's suppose we prepared a budget for quarter number 1, right? And we got the actual results. Now for quarter 2, we will see what happened in quarter 1 and which factors are going to continue in quarter 2. What are the changes we are expecting? Like in quarter 1, the dust set. everything got settled. And we know that how economy is going to shape. The government did some agreements with the other countries instead of US. And they're trying to make sure that exports there will be no impact on exports of our country, let's say India or any other country. So in that case, we know that how demand will continue. So we will see 1 or 2 quarters, and then when we see that okay, fine, things are normalized, and we know we can predict for the 12 months, we can go for 12 months. So that's basically what the rolling budget concept is. So if the uncertainty is in the environment, you cannot prepare budget for 12 months and try to stick with the budget. You have to continuously roll it. Every time you need to revise it by seeing what happened in the last period in that. The problem with this is that you have to go for sort of burden of preparing budget like 4 times in a year. That's something which is quite terrible. You need to train the workers for preparing the budgets. You need to motivate them that look, this is good for the company. Because if I'm the employee, initially I was preparing one budget which is sufficient for the whole year. Now I have to prepare the same budget in four different times in a year. So obviously I'm getting the same salary. So I will not be happy with this decision. So you have to motivate me. First of all, you have to motivate me to do that. Right. So these are few things which are the problem with the rolling budgets. Then the concept of let's try to do zero-based budgeting. Zero-based budgeting, I personally think that zero-based budgeting is something which the examiner will just ask in a theory. There will be no calculation. I mean, it's 0.01% chance that there will be a calculation because generally it's theoretical. Examiner asks theory. Calculation maybe examiner will ask in AP and data. So zero-based budgeting, if you ask anyone, any student, what is the concept of zero-based budgeting, the student will start and end like this. Zero-based budgeting is something where company start from scratch. A company start from a 0 point. Okay. What else? I don't know anything. But a student will generally say that zero-based budgeting starts from zero. And this is the only statement which they have in their mind whenever they are talking about zero-based budgeting. So I'm just trying to recall what we did in zero-based budgeting concept. In my opinion, examiner will simply ask you to explain zero-based budgeting, maybe the 3 steps of zero-based budgeting, or examiner will give you a scenario. You need to connect it with a scenario. Let me tell you how. See, there are 3 steps of zero-based budgeting. The first step is to identify. Identify is not a good word. Prepare. Prepare decision packages. Decision packages. Decision is not the right word here. Okay, continue with. Prepare decision packages. Decision packages in that sense that let's suppose you are the manager of maintenance department or you are maintenance of canteen, manager of canteen department. You need to have a minimum package. Minimum package in the sense which is something which is required minimum for if you want to continue. Like if you want to have a canteen, at least you have to provide basic meal, one curry and maybe one roti or whatever you call it. So basic requirement is there, and then there are some incremental packages. Incremental in the sense that okay, fine, if you want to feed your labor with some good food, at least one day in the whole month, what extra you need to have. But that's completely optional. If you don't want to do it, if it's not giving you any benefit, don't do it. Right. So that's what we mean by incremental packages. That can be the case with maintenance, that can be the case with canteen both, right? And then we go for 2 or 3 incremental packages. The next step is to rank these packages according to the benefit. Benefit can be profit percentage, benefit can be ROI, benefit can be profit. Generally, it's in case of profit, and in case if it's canteen department, you can have the what benefit we can have if we are not letting people go out and have food, like 30 minutes of each employee on a daily basis can be saved, multiplied by the contribution per unit, you will get the overall benefit, right? And then we can rank product according to the benefit, and then you have to allocate the funds according to the ranking. Now, let's suppose the examiner give you a situation where it says that the company is, uh, let's suppose the company is trying to have the zero-based budgeting in a department which is in a process of product development. Right? It's in the process of it's trying to develop some products. Right? One more thing that is important in zero-based budgeting is that it is applicable in a situation where you can let go something like optional thing. Like let's suppose if you don't want to have maintenance department, we can skip that. But you cannot say that we cannot have a production department. That is a compulsion, right? You cannot let it go. That's important thing. So let's suppose you have zero-based budgeting in a production development department. How you will apply zero-based budgeting in that? First of all, you have to product development, like there is a product, there's a division which is developing certain products for the company. So first of all, you have to come with decision packages. Decision packages that let's suppose you are having two products. What is the basic facilities or basic thing you want to provide to the customer? Like let's suppose we are talking about a mobile phone, right? So what is the basic thing which you need to do? For me, it's processing. For me, it's storage capacity, maybe processing, and maybe camera or something. These are the basic things which people generally need. What alternatively, what you can provide is that you can add a pen like Samsung was doing initially, S Pen, or maybe you can provide some security feature, or maybe you can provide some other phone thing, but that is an optional thing. Basic product development require this. Then we can go further. So you have to allocate funds accordingly, right? And then you have to rank the products according to the benefit. So what can be the benefit? Benefit is that we will only approve those products which are, we will only let you to develop those products which have more benefit. So if you came across a product which has lesser benefit, we will say, okay, fine, just forget about this product. We are not going to develop this product. We will not allocate funds for that based on the profitability. And then we give you the funds to develop the product. So that's basically how we can do, but it's unlikely that examiner at F5 position, F5 student will ask you to apply zero-based budgeting in a certain concept. Okay. So, and the last one is zero activity-based budgeting. Activity-based budgeting is quite similar to activity-based costing. What we are trying to do now is we are trying to manage the activity because we believe that the cost is driven by the activity. So if we have production, let's suppose we said that we have to produce 5,000 units of A and maybe 15,000 units of B, right? And we know that the, let's suppose batch size is 500, batch size is 500 for both cases. So the number of batches will be 10. Right. We need 40 batches, right? And and then production department says that, hey, we cannot have 40 batches. We have the capacity to produce only 35 batches. We cannot produce 40 batches. What we are going to do? What we can do is we can increase the batch size to 600 if so that will number of batches will reduce, right? Or let's suppose that the quality control department is saying that 4 inspections are done for A, and 8 inspections are done for B. 8 times 3 is 24. So 280 number of inspections you need to do for product for in totality. And let's suppose you don't have enough capacity to conduct quality control, quality inspections for 280 batches, 280 times. You can ask for, okay, fine, we need to reduce this to maybe six number of inspections, or maybe if we increase the batch size, number of batches will reduce and quality inspections will reduce. You are trying to manage the activity according to the production, and then what those activities will cost you. That's basically you are going to prepare the budget. So it's activity based costing in a reversed manner. If you really want to manage the overall cost by using activity based thing, so it's very similar to activity based costing. The only idea is we are trying to manage the activities and cost in terms of budgeting. Right? So what we are going to do now is we are going to start with our rolling budget question. Can we start? Do you guys need a break? I'm not sure. You guys need to take a break.
We'll take a break of like 5 minutes.
Okay, a very short break. We have to grab a cup of coffee, maybe 5 minutes, and it's 10 a.m. here. We will continue at 10:15. Right? 10 minutes break. 5 minutes break. Okay, so I hope I am audible. Okay, so we are going to start with this question, which is for rolling budgets, right? Okay, Strict Company is a multinational. Strategy Company is a multinational consumer goods company. Traditionally, the company has used fixed annual budgeting process in which it sets quarterly sales revenues targeted for each of its product lines. Historically, however, if a product line fails to reach its sales revenue targets in any of the first 3 quarters, the company's sales director and finance director simply go back and reduce the sales revenue targets for the quarter just ended to make it look like the target was reached. They then increase the target for the final quarter to include any shortfalls in the sales from the earlier quarter. So what they are trying to do is they are trying to manipulate. They are saying that even if we cannot meet the target, or if we cannot meet the target for any of the quarter, we are going to change the budget. It's and why they will be interested to do so, because they want benefit. Because if you meet the target, generally you get the benefit. So in order to get the benefit, what they are doing, they are just going back and changing the targets. Is it a good idea? Of course not. You are trying to manipulate with the company results, right? Okay. And then at the end, and what they do is in the last quarter, they adjust everything. Like, for example, if 20 million was short in the first quarter and 40 million was short in the second quarter, they adjust the 60 million in the last quarter by increasing the budget to by 60 million. So that's basically what they are doing. So they are actually creating they are manipulating the result budgets of first 3 quarters, and then they are also manipulating the budget for the last quarter. And both are wrong now. Both are inappropriate now. During the last financial year ended 31st August 2006, this practice meant that managers had to heavily discount many of their product lines in final quarter in order to boost sales volume and meet the increased sales target. That makes sense because you have artificially increased the budgets. Obviously, you have to do a lot of things in order to meet the target. Even with discounts, however, they still did not quite reach the target. On the basis of sales targets, at the beginning of the year, the company had also invested 6 million in new production lines in January 2006. So when they invested in January 2006, right? Okay. However, to beginning of the year, However, to date, this new production line has still not been used. As a result of both of these factors, the company saw a dramatic fall in return on investment from 16% to 8% in the year. Like sales volume is not achieved, and then project did not start. ROI significantly fell from 16 to 8%. Consequently, the managing director and the finance director and the sales director all have been dismissed. We fired all. Two key members of the accounts department are also on sick leave due to stress and not expected to return for some weeks. A new managing director who is inexperienced, now this can be important, with inexperience in this industry, has been appointed and is in the process of recruiting the new sales director and the new finance director. He said these mistakes could have been largely avoided if company had been using rolling budgets instead of manipulating the fixed budget. From now on, we will be using rolling budgets, updating our budgets on the quarterly basis with immediate effect. So that's basically what they are doing. I mean, he said that problem could have been that in quarter number one, some situation is quite dynamic, is changing with the passage of time. So you are not changing the budget accordingly. You are still going with the original budget. He believes that this is the problem. The original fixed budget for the year ended 31st August 2007, for which the first quarter has adjusted just its own value. So this is original fixed budget, right? Original fixed budget is this one: revenue, cost of sales, gross profit, distribution cost, and administration. Um, this is the original fixed budget. The budget was based on the following assumption: sales volume would grow by fixed compound percentage each quarter. Gross profit margins would remain stable over each quarter. Distribution costs would remain fixed percentage of revenue each quarter, and administration costs would be a fixed cost for each quarter will be fixed. So growth of sales volume, gross profit percentage with respect to sales, distribution cost with the percentage of revenue, all is going to remain in, and administration cost is going to be a fixed cost each year. The actual results of the first quarter have been reproduced in R as follows, right? And they say that revenue was 14,096, cost of sales is this one, gross profit is this one, distribution, administration, and operating profit. Everything is there. The new managing director believes that the difference between the actual and budgeted sales figure, for quarter one is the result of incorrect forecast prices. However, he is confident that he is confident that the four assumptions of the fixed budget were correct, and the rolling budget should still be prepared using the assumptions. Right? Now you are required to prepare a rolling budget for the next 4 quarters, that is for 8. Right? So how we are going to prepare this rolling budget? We are supposed to prepare this rolling budget based on these four assumptions, right? And so let's try to do it on Excel. Okay. Let's try to make a format, and then we'll do it. Quarter one, quarter two, quarter three, and quarter four. Sales revenue, then all of the cost of sales, gross profit, and distribution costs. Sorry. Administration costs and operating costs. Right? And since all figures are in thousands, even thousands, yeah, figures are in thousands because the actual results are in thousands. I think I forgot to mention it earlier. Okay. So okay, now how we are going to prepare this? See, we will prepare budgets on the basis of the actual results. Like we will take the quarter one actual results and we prepare budgets for quarter two, quarter three, quarter four based on what happened in quarter one, right? So let's try to have quarter one actual results. Let me try to identify here that this is actual. Okay. Okay. So actual is 14096. Actual is 8740. And then this minus this. 5356. Distribution cost is 705. 2020 and 261. Okay. And okay, now. Okay. Now. Revenue. Now, how you will, the question says that sales volume would grow by fixed compound percentage each quarter. So we don't have the revenue of actual revenue of last year quarter four. If examiner give us actual revenue of last year quarter four, so last year quarter four to for this year quarter one, we could have calculated the percentage thing, but that is not given here. So because of this limitation, we will use the budgeted sales revenue percentage code, right? So sales growth. And this will be, you can take any quarter because it's budget percentages are generally same. So let's try to take it in. 694 minus, right? Let's try to make it in percentage and okay. So sales growth are almost 2% each quarter, right? So we will take the actual revenue and we will grow it with 1 plus this figure, right? And let's try to make it in dollars. So keep it fixed, right? And we will, oh, can we do it like this? Yes. So what we did is we kept the last year actual results, and then from quarter one, quarter two is 2% more of quarter one actual, and quarter three is based on quarter two, quarter four is based on quarter one. How many quarters that wanted? It's the same next 4 quarters. Next 4 quarter means that there will be quarter one of next year, right? Okay. So this will be like okay. So this is one more quarter. Now, cost of sales. How you will calculate cost of sales? Cost of goods sold. The question says that what are the assumptions? Assumption says that gross profit margins will remain stable. If gross margin is expected to remain same, is expected to remain stable, that means what? That means cost of goods sold percentage will also remain same, right? So gross profit percentage will be what? That will be the difference between gross profit divided by sales, right? And then in percentage. So it's around 3.38%, right? And if gross profit is 38%, what is cost of goods sold? Cost of goods sold will be 1 minus this figure. So it's around 62% is the cost of goods sold. So cost of goods sold is based on the revenue. So this will be cost of goods sold, right? This figure. Let's keep it in dollars. Oops, sorry. And then multiply it with revenue. Not in percentage. No, 64. Okay, so let's 62%. I'm not going for the reason why it's doing this. We are getting out of time. So 60% of this figure, right? Yeah, very 4%. technically it should not create a percentage sign here, but let's forget about this. Times this one, right? They are I'm not connecting it because it will create a problem. So we just did 62% of the sales revenue, right? And what is the gross profit? Gross profit will be sales revenue minus cost of goods sold, right? This will give you gross profit. And distribution cost. Now, distribution cost is what? Distribution cost is 705 divided by 14906, right? So multiply by this. And then they say that administration, they said administration cost will be fixed in all quarters. So that was actual administration cost was 2020, and we will continue with 2020 in all years, in all quarters. Right? And then we will have a profit. Something is going wrong with this Excel, I don't know. Gross profit minus this figure minus this figure. So it's 27 is 1. Okay. So these are the profits for all the 4 quarters. So what the basic idea is? Basic idea is that if you are calculating rolling budgets, all of these percentages are based on what happened actually in quarter 1. So we are assuming the gross profit will remain same, but whatever the gross profit was in quarter 1, that is supposed to remain same. The only budgeted figure which we use here is this 2% growth because we don't have what happened in the last quarter actually, right? So if examiner give us that figure, we could have calculated the actual growth percentage, right? So this is basically the thing. So that's basically all what you have to do for 8 months. Now, the next part is quite interesting. The next part is saying that the problems, discuss the problems, and this can be a challenging one. Discuss the problems that have occurred at a static company due to previous budgeting process and improvement that might now be seen through the use of realistic rolling budget 6 months. The examiner is asking you to discuss the problems that have occurred at static company due to previous budgeting process like fixed budget. And now you're supposed to identify that how rolling budgets is going to solve this. Right. So what are the problems and why you think that rolling budget is a better option to sort it out? I'm giving you 2 minutes to think that what points you will write in this. Right. What points you will write in this? At least 2 points, 2 to 3 points, and then we will discuss. Just take 2 minutes to think. I mean, you have to identify why static budget is a problem. Okay. So try to identify problem with this question. What are the problems? Any idea? Anyone who can comment anything? Because it's a technical one. I think it can be something which the students feel uncomfortable with. Yes,
The problem in the first paragraph, they increased the target for the final quarter to include any shortfalls in sales from earlier quarters. That's a problem because if they didn't achieve that in the earlier quarters, how are they sure they're going to achieve that in the final quarter?
exactly. Okay. See, the first problem is that initially, what the problem is, a static budget is giving them a budget for the next 12 months, right? And they don't have any option of changing it in the middle of the year. Let's suppose that you made a budget in January and then you are not in a position to export. Obviously, you need to revise your targets, but we are not allowed to do so. Probably we cannot. I mean, we have prepared a static budget. So, what they are trying to do is instead of revising the budget, they are manipulating it. I mean, see, the difference between rolling budgets and in this case is that they are saying after 1 month, they are saying that the budget of the previous one was this one, right? So that's basically the problem. And why this is happening? Because they are not allowed to change the budgets. They are not allowed to revise the budget, right? And that's probably the reason that even if there is a change in demand, they are not supposed to do it. And when this is changing, they are now going back and changing the original budget. So they are doing the rolling budget thing, but in a very stupid manner. Stupid in the sense that they are actually creating a false reporting type of thing, right? So this is the first problem, right? And then the problem is that again, what you said that if they were unable to achieve the budget in the first 3 quarters, how you will achieve the deficit in the last quarter? So for that, they were heavily giving discounts to the customers in order to increase the sales. So if they are discounting it, it's not a good thing for the company because there are two issues. The first issue is that the revenue of company will reduce. Number one. Number two, you are giving a false impression to the customers that at the end of the year, selling prices are going to reduce, like in sale or something, flash sales or some sale. So people will have in mind, people will stop spending in the first 3 months, if first 3 quarters, if this is a discretionary spending, and they will try to spend money at the end of the year. So majority sales will occur in that case, or if customers are transferring, obviously your revenues are going to go down. And then in the next year, you are again trying to increase the sales. So maybe it's psychologically difficult for the company to increase the sales again, right? To come back to the original selling price. So these are the issues, right? The second problem is that they invested, this is also related to sales. During the last financial year, ended 31st August 2006, this, uh, nine, oh no, not this one. Even if it is on the basis of the sales target set at the beginning of the year, the company had also invested 6 million in a new project in line project production line in January 2006. And what was the year end? Year end was 31st August. So in January, like August, September, October, November, December, and probably in January. So probably you are taking decision on in January for the sales you have forecasted in 5 months back, not in 5 months back, 5 or 6 months back. So if those sales were not depicting the correct picture, obviously the decision which you have taken is incorrect. is inappropriate, probably. So if you have rolling budgets, this investment will be based on the results, on the sales of most recent month. And probably that could have been a better option for the company, right? And then obviously you ask them to leave and then the new person comes in. So how rolling budget is going to improve this? Rolling budget is going to improve this because of two things. The first thing is that the budgets, I know that last year this happened. So the next year, like for example, if I am in the second quarter, the third quarter budget will be based on second quarter. So whatever actual happened in second quarter will get reflected in the third quarter. And probably because of that, I don't need to manipulate the results because already the budgets are reflecting quarter two position, right? So that's how rolling budgets will improve. And again, sales target will be based on the most realistic figure. That's also something which company can improve by using rolling budgets, right? So I am not writing it. I've already written it. I'm just showing you how we can improve, how we can write this. Let me try to in this one here. Yeah. So there are multiple problems that can be identified from the current scenario of a static company. Firstly, the managers are changing budgets to showcase that they have met the target. This is a false reporting of performance and obvious reasons. By the way, how many marks to allocate? That is something which is important and we need to consider. There are 6 marks, right? There are 6 marks for this one. So at least we should have 2 problems, 2 or 3 problems, and we have 2 benefits of using rolling budget. So that will cover up around 6 months, right? There are multiple problems. Okay, fine. So since the bonus is not based on the actual performance, it can be treated as fraudulent activity by them. I mean, actual performance in the sense the target which they are showing that they met, actually they missed that. After manipulating the targets, they are then trying to cover up the deficit by reducing the selling price at the end of the year. This can have 2 issues. One, with the customer will build an expectation regarding the lower selling prices, and it may be difficult for company to bring selling price back to normal. And obviously, your sales will also shift to the last quarter. Another issue is that company is facing is that the decision. So we have identified 3 issues, 3 problems, and then in the last paragraph, we have suggested the improvement. So what you can do is, if you want to make the examiner life easier, problems with fixed budget, right? We can put a heading that will be a good option. Right? So if this will give examiner a better idea of what you have written. The most obvious reason why managers involved in such window dressing is that unrealistic budget has been prepared, making the rolling budget it more realistic as the budgeted figures will be derived from the actual results generated from quarter one. This leads to more achievable goals, which can significantly boost directors' motivation and elimination of the temptation to manipulate the outcomes. Similarly, the investment. So here you can change the paragraph also. So examiner will identify, okay, fine, this is the second point. Similarly, the investment decisions that are based on performance of the company will also be more realistic, as the proposal will be based on the recent and realistic figures, sales figures, or figures, because every project will not be based on sales, reflecting the recent market trends. So initially, it seems that it's a very tricky question, but in my opinion, whenever a tricky question comes in like this, all what you need to do is to take a deep breath and try to see, okay, fine, what we can do, how we can connect it. Don't write the general theory of the problem of fixed budget and general benefits of rolling budget. If you write the general benefits of rolling budgets, examiner is not going to give you marks because you have not connected your answer with the theory. Sorry, theory with the situation. I am telling you to tell me how my problem will be sorted out by using rolling budgets. You are telling me the general benefits of rolling budgets. what I'm going to do with that, with your answer. I'm asking you to apply the benefits of rolling budget to my company. So you're not supposed to give me the general answer, right? That's basically the thing. Last but not the least, there is one more requirement. Discuss the problems which may be encountered when a static company tries to implement new budget. And what is a new budget? New budget is a rolling budget. So if you are trying to have a new budget, can you identify 2 points or 3 points, the problems which the company may uh, face if company wants to have a rolling budget? There's a problem which I identified earlier. The first and the most important thing is the new managing director with inexperience in this industry, right? So the person who is at the topmost position is inexperienced in this industry, and asking him to prepare. Okay, fine. Let's start with this one. The first problem of rolling budget is that you have to prepare budget 4 times in a quarter. So you have to mold the answer with this one. That with a company, static company is now supposed to manufacture, prepare the budgets 4 times in a year, right? That's going to be a lot more workload for the employees, right? So you have to motivate employees in order to make sure that the rolling budget actually has the true essence. Like if I ask you to do 4 times budgeting, and I'm not motivating you enough, what you will do? You will try to figure out some shortcuts. I mean, like maybe your rolling budgets are not realistic in that case if I'm trying to impose my decision, right? So that's the first thing which you need to do. The second thing, the good part is that you're managing that everyone who was prepared, who was in the previous setup, has been dismissed. So the new manager is coming with a fresh mindset. But the problem is that he is not experienced. So experience, if he is inexperienced, he may do some mistakes, right? So you have to conduct training sessions, workshops to deal with how the rolling budgets work, right? Then you are continuing. The manager is saying that he is going to continue with the same assumptions. There was something assumptions was given. I'm unable to locate it. Hmm. So assumptions of the fixed budget is now going to remain same. So he is not actually reassessing the evaluating the 4 assumptions. He is just making sure that whatever assumptions he made was correct. So that needs to be re-evaluated in order to get a better version of the result. So training costs, inexperienced management, training issues, same assumption issues, and workload, employee motivation. All these are problems which company will face whenever when they are trying to go for rolling budgets, right? So these are the general problems of rolling budgets. We are just trying to restate them with respect to the company, right? Okay. I will share this question with you, and I will also. Now, what you have to do, let me try to explain. This is activity-based budgeting. We don't have enough time to do that. What is activity-based budgeting here and what they're asking? First of all, they're trying to explain means principles of activity-based budgeting. So activities budgets are based on the activities which are creating them. In this case, company will be able to manage required activities, and if they need to change any activity in terms of in connection with the production, and then it consider the costing. So the basic idea is that um, you have to take decisions based on the activities of the production, basically, So this is a basic description of activity-based budgeting. And this is something which is important. Calculate for any spare capacity or shortage in the hours required to meet the expected monthly output for production machine time, quality inspection, and shipping administration, right? This is for 8 months. So the question is giving you some basic idea that what are the production and how we are going to make that. And you just need to identify whether the whether the resource is in excess capacity or whether the resource is in shortage, like is kind of limiting factor, kind of something which you need more, right? And then you have to discuss the implications of your finding for the company's social production, right? Let's suppose that I'm just giving you an idea. You are supposed to do it. Please try to attempt it. There are three activities, right? Let's suppose that this is in shortage, this is in surplus, and this is in surplus. I'm just assuming, right? I don't remember which one was what. So if you have one resource in shortage, what will you do? That answer will tell you to arrange the machine time, right? Maybe you can hire a new machinery. Maybe you can, probably you need to hire more machinery in order to, prepare the production, right? Because if you have more machinery, you will be able to have more output because the rest of the resources are in surplus quantity. But let's suppose that the company says that we are unable to hire any new machinery. Then you need to figure out what you will do with these excess capacities. Will you have any option to, you know, uh, create any opportunity by using the extra resources? Right? So that depends upon what the situation is, what is your answer. So I think you need to come up with at least three implications. Three implications in the sense, one for production, one for quality, and one for shipping administration to answer this question. Right? So yeah, that's it. So I will try to share this question along with the answer so that you can try this at your own. Okay. So in these 2 days, we try to cover up maximum course which we couldn't do in our regular sessions. Like in regular live sessions, we cover variances and performance measurement. And in these two live sessions, we try to cover decision making completely and throughput costing and EMA, which is a problematic area in section A, and budgeting section, which is again a problem. So I will be sharing today's 10th of August. In a day or two, probably, I will share mock papers with you guys, right? I'll try to prepare 2 mock papers for you. So try to, after finishing your paper, your preparation, try to attempt those papers. Check section A and section B at your own. Mark it. If you have any query, you can definitely ask me. For section C, you can share your answer scripts with me if that is performance measurement or variances. If it's decision making, then still you can check it at your own. Performance measurement and variances theory part is something which is crucial that I really want to check. Okay. So any comments from your side? Anything you want to discuss further? Because we are just going to wrap up this session. Okay, you are not going to say anything. So we are finished. I'm finishing this session now, right? If you have any problem, any query, any issue, just WhatsApp me. I will try to respond as soon as possible. I will try to sort that issue out. Like there was a student who asked me for the past paper of performance management. So I shared a folder with him, which contained on majority of the past paper because now ACCA is not releasing the PDF version of past papers. That is available at students portal, so you can access from there. Student practice practice session. TV practice platform has all those past papers, so you can attempt it from there, right? So yes, that's it for today. All right.
Thank you.
Thank you. Take care. Bye bye. Have a nice day. Bye bye.